Hey, we're back. It's Thursday afternoon, 2 p.m. here in the Coachella Valley on the Pacific coast of Southern California. My name is Jeff Harrison. And, here in the desert, we have the tennis tournament going on right now. And it's kind of fun watching these players play, especially now they're the quarterfinals. And if an underdog wins, you can hear the crowd get behind them. Well, that's kind of what happens whenever you connect with Art Alvarez of MortgageWorks. He helps you win, get over the line. The cheering goes on, and it's just an exciting moment. Well, this week is no different. Let's bring Art on right now. Hey, Art.
Hi, Jeff. How are you?
Good. Welcome to the show. How are you today?
I'm all right. I guess I'm an underdog. Is that what you're trying to say?
No. You are the guy who makes sure the underdog wins.
Oh, I see. Okay.
Yeah.
Yeah, I fight for the underdog. You're right. Okay, I'll take
That's
that.
right. That's
I'll
right.
take that.
There's no little guy in your corner.
No.
Everybody's a winner.
Yep,
So,
that's right.
hey, I know you've got a full show today, so I won't hold us up, but I do want to let people know if you're joining us live, this is an opportunity for you. If you have questions when it concerns anything about loans, whether you're a homeowner or a home buyer, please put them in the comments. Art will answer them before you get off the air. And then if you're watching afterwards, please put your comments in the comment section. And again, Art will follow up. With that, Art, I'm going to turn it over to you. Have a great show.
Okay. Thanks, Jeff. Hello, everyone. Welcome to this week's Mortgage Minute. I want to get right into the interest rate situation right now. As you know, we usually start the program with an update for you on mortgage rates as well as the bond market. There's our rate grid for today. It has been updated to reflect current conditions. Unfortunately, rates have trickled up a little bit. Today, we had about an eighth increase in rates just today. So as a result, when you look at this rate grid, we're still hanging on to around mid sixes on a conforming 30-year fixed, right under 6% for FHA VA. And of course, the temporary buy downs, the 2-1, 3-2-1, those are with note rates in the mid sixes, about 6 5/8 on the note rate. One bright spot in terms of rates, frankly, are HELOCs. HELOC rates have not really changed since last July. And we're actually getting pretty good activity right now on fixed rate seconds. We're offering some really good rates on fixed rate seconds. Those are fixed rate loans from 5 to a 30-year term. And we can actually offer rates on those. It's actually better than a HELOC. So for the right circumstance, a fixed rate second can be a really good option. So if you look at the 10-year bond yield chart that Jeff's going to bring up here you can see what's been going on since last Friday. Unfortunately, we've got the wrong kind of incline there on the 5-day chart. Last Friday, we were actually under about 410 on the yield. In fact, we got around 408, 407. But unfortunately, as you can see, we're ending today at just under 430. So what is causing that? What is going on in the financial markets to cause this uptick in rates? Well, it turns out this week, remember last week, the data points, the economic calendar data points was pretty light. This week, the calendar is all about inflation data. This is the CPI, PPI week. And of course, even a person who doesn't pay attention to financial news often probably by now knows what CPI and PPI is. CPI is the Consumer Price Index. That came out first. In fact, that came out yesterday. And here's what's kind of interesting. It kind of shows you how little a change in numbers can really affect the market. The CPI was 0.4 in February. That's the number that came out yesterday. The forecast was 0.4, so actually no change there. The core CPI, now that's the Consumer Price Index excluding food and energy. They're considered more volatile. So the core CPI, yes, did have a slight uptick of 0.1% in February. 0.3 was forecast. So it came in by 0.1 higher. Well, of course, the financial markets, the financial news media takes that to say inflation's hot. The CPI came in hot. Well, just that one little 0.1 increase over the forecast is enough for the markets to get jittery. And yet, here's the thing, year over year, the CPI that came out was unchanged. And core CPI was actually down year over year by about 0.1. So despite that, the reaction was generally negative on this hot CPI number. And then today we had the PPI, the producer price index. Producer price index is essentially your inflation indicator at a wholesale level. And the forecast was for February was 0.3 was the expectation. Well, that actually did come in, quite a bit hotter, if you will. For February, it was 0.6, not 0.3, 0.6, so double what was forecast. Interestingly, though, year over year, really no change. And then the core PPI, that's the core wholesale inflation number, again, without food and energy, forecast to be 0.2%, down from 0.6%. Now, it actually came out at 0.4, so it was higher. Core CPI, our PPI came out higher, 0.4 versus 0.2 forecast, but and 0.6 previously. 0.4, the year-over-year numbers is actually lower than the previous, and yet higher than forecast. So that's considered negative, and it's caused the market jitters. That's what drove the 10-year bond yield up today, basically by about 10 basis points, from about 419, 418 back up to almost 430. Next week is the Fed meeting. So basically between now and next Tuesday, Wednesday, you're going to probably see the bond market being relatively flat, waiting for that meeting as everybody is on the edge of their seat to see what the Fed has to say after they conclude those meetings on Wednesday, late morning our time. All right, so stand by for that. We'll see what happens with rates from there. The bottom line here is we're in a range of what I would call bounded volatility. We're in the sixes, high sixes, low sixes. I think we're going to be in that range for a while. If we can break through 6, get into the 5s, that might spur the market a little bit. But we're going to be at these levels 6 plus or minus for, I think, an extended period of time. So there's your rate report for this week. Now what we're going to do is move back into the California Dream for All program again. This is the hot product, the hot kind of program everybody's talking about. Today, I want to share with you a video where a representative of the California Housing Finance Agency is interviewed. And it's a really good video in that it summarizes the program, I think, very succinctly. Then I wanted to have you take a look at it.
Next month, California will relaunch a popular program that gives affordable loans to first-time home buyers. But this time, the state is tightening the requirements for applicants. The California Dream for All program rolled out last spring on a first-come, first-served basis, and there was huge demand. In less than 2 weeks, that program used up its entire $300 million budget. Just over 2,000 applicants received no interest, no monthly payment loans to help with the down payment on a home. Joining us now to talk more about what will change with the program this time around, Eric Johnson, a spokesperson for the California Housing Finance Agency. Eric, thank you for the time. We appreciate it. Let's start first with how things will differ for applicants this go around. As opposed to it being a first-come, first-served basis situation, this time the state will be choosing applicants by lottery. And there are some other changes we want to put up on the screen as well. The other change is that along with having applicants be first-time home buyers themselves, we also understand that their parents cannot have owned a home either. Can you talk about the reasoning behind these new requirements?
Sure. We wanted to make sure that these funds are distributed fairly and equitably. As you said, the first come, first serve aspect, it's not fair and equitable. So what we're doing is we're having a lottery system this time. We're asking people to work with one of our approved lenders, get your credit score, get your debts all squared away, and you've got a month and a half to apply for the program. Anywhere between April 3rd and April 29th, you can submit your voucher application. The first generation homebuyer requirement is a new one that the legislature told us to implement for this round. Again, from a fair and equity standpoint, what that means is that at least one person on the loan cannot have owned a home in the past 7 years. Mm-hmm. Also, that their parents don't own a home. And so much of the inequity in California is caused by inequity in home ownership. Being able to own a home and pass on that generational wealth to the next generation is really a foundation of making it so that a family is able to accumulate wealth. And this program is designed to kickstart it among people who may not have had that opportunity to either inherit a home from their parents or take advantage of wealth that they got from selling a parent's home.
Yeah, that certainly makes a lot of sense. Is there anything that has changed in terms of the income limits for applicants this time around?
Yes, income limits are slightly lower. but they're still pretty generous. In Alameda County, for instance, the income limit is $234,000. In Sonoma County, it's $202,000. So in all the counties in the Bay Area, it's still very, very doable from an income side.
All right, I want to put up on the screen here to sort of lay out what it is that if you are fortunate enough to win this lottery here and you qualify as an applicant for the Dream for All program, what this would mean for you. Applicants can receive $150,000 or up to that amount for a home, for a down payment on a home, or 20% of the purchase price, whichever is less. And these loans are interest-free. There's no payments that have to be made until the home is either resold or refinanced here. Talk about what happens when a Dream for All loan eventually comes due. What do borrowers owe the state? How does it all work?
Well, this is a unique program. It's never been tried at this scale in the United States. It's a shared appreciation program. So when you sell or refinance the house, in addition to paying back the amount of the initial loan, you also pay back a share of the appreciation in the home's value, up to 20% of that. And then we use that money to fund the next round of home buyers. So a quick example, say you buy a home for $500,000 and sell it for $600,000. You'd get a loan of 20% of that $500,000, and then you'd have to pay back that $100,000 plus 20% of the appreciation of the home. So you end up paying back $120,000. That's instead of charging interest on the loan or having monthly payments on that second loan. You will still have monthly payments on the first mortgage of the home.
All right. Well, I know it's going to be an incredibly popular program here the second time around. Thank you for laying out some of the new requirements here with the California for All home financing program here. Eric Johnson is with the California Housing Finance Agency. And we should point out here that online portal to apply for this loan program opens up in the first week of April. Eric, we appreciate the time. Thank you for doing it.
Thanks so much for having me. Appreciate it.
Absolutely.
We're actually going to now cover a question that's not in this video directly, but something that occurred to me I wanted to bring up after we covered the Dream for All program last week. And here's the question: How does foster care factor into the first generation eligibility test for the Dream for All program? What that is all about is in the first generation eligibility test. Remember, as the video just described, at least one of the borrowers has to be a first-time home buyer, not just for 3 years, but for 7 years. And then there's a second level of eligibility related to first generation test. And that is not just the 7-year first-time home buyer status, but also that your parent or parents do not own a home currently. Or if your parents are passed, you have to certify that when they were alive, did they own a home? Or in the case, by the way, if you don't have contact with your parents, you're maybe not in good relations with them, maybe you don't even know where your parents are, then you have to certify to the best of your knowledge that if you believe they're alive, that they are not currently homeowners. So what about the foster care? Well, it turns out the foster care is another option for eligibility other than a parent not owning a home. And so the way it works is either you have to certify or verify that your parent doesn't own a home, or you have to establish that you were at any time in the foster yourself, the borrower, were a product of the foster care system. And if you were, that would make you eligible for the Dream for All program. So keep in mind, therefore, that, again, it's really 2 issues, or really 3 issues. 7-year first-time home buyer status. If your parents are alive, they cannot own a home. If your parents are passed, you have to certify they didn't own a home before they passed. Or other than the parent criteria, or if you can verify that you are a product of the foster care system, or in some system where you're in a living facility with a large number of children being cared for by staff who are not related to you, that makes you eligible for the California Dream for All program if you also are 7 years since previously owning a home. So that's a nice little wrinkle that might help some people who otherwise are being prevented from being eligible. We've gotten a lot of inquiries on this program, as you can imagine, but quite a few, unfortunately, I've had to say no to because their parent owns a home, or when their parents were alive, they owned a home. And so that causes them to no longer be eligible. So good question. Keep that in mind for anyone you know who might be eligible, or this program would be beneficial to. Anyone you know or anybody in your family, if they're were involved in the foster care system, that will help them with eligibility. Okay, with that, I'm going to go ahead and go on to the next subject. And this one, I'll have to admit, this is a little bit of a rant on my part. So just understand that as it relates to the headline here on this particular side. U.S. mortgage rates, get a grip. What do I mean by that? Well, I've been thinking for a while about the fact that I see constantly all the financial news and written articles, or if you watch the financial business channels early in the morning, there's all this continues still hand-wringing about mortgage rates, and they're too high and they're unaffordable, and it's really an obstacle in people buying homes. So it got me thinking, what is going on with mortgage rates as opposed to other types of lending? What about rates on other types of lending, and what's going on with that lending activity vis-a-vis the rates for them versus mortgages? Well, I've got some interesting numbers here for you. In 2023, the average mortgage rate, about 6.8%. And keep in mind that the U.S. mortgage debt balance right now is about $12 trillion. And so that 6.8% rate, of course, much higher than it was in 2020, 2021. In fact, frankly, a little bit more than double. So everybody's up in arms about rates are way too high. I can't buy a house. And of course, as a consequence, what's happened with the mortgage market? Volume is down. It has been down now for really going on a couple of years. But yet, let's look at some other types of borrowing. Auto loans, average in 2023, 7.7 for new cars, almost 12 for used. Now, currently in the U.S., there's about 1.6 trillion in U.S. auto loan debt. Now, here's what's interesting. Even though the rates, which are at new record highs for auto loans, volume of auto loans has gone up, even though the rates are at 15-year highs. That seems rather odd, right? With the mortgage market, rates go to 6.8, volume is down. Auto loans, rates are at 15-year highs, and auto loan volume is not down, it's up. Let's take a look at another type of lending, personal loans, unsecured personal loans. The average rate of an unsecured personal loan in the U.S. is over 12%, 12.17. Now, the amount of personal loan debt is a lot smaller, about $241 billion in the U.S. for 2023. But the rates for personal loans, unsecured personal loans, are at an all-time high again. And what's happening with the volume for unsecured personal loans? It's up. Interesting, right? And then we've got credit cards. I've talked about them before. In 2023, the average credit card rate was almost 23%. And credit card debt has exploded. It's now 1.13 trillion in the U.S. And that's an increase. In fact, U.S. credit card debt has increased by over 34% in the last 2 years alone. So what does that mean? Yes, volume is up. So how can it be that auto loans, unsecured personal loans, credit cards, the rates on all those are at record highs too, and yet the volume of that kind of lending is all up relative to mortgage loan lending, which is down? Now, obviously, auto loans and unsecured personal loans and credit card loans are a smaller portion of the total U.S. debt load. Yes, obviously, the mortgage is a bigger loan than any of these others. Yet, it's interesting for the consumer in general to believe, oh, the mortgage rate is bad, and yet they're ignoring very high record rates on all this other type of lending, in particular credit cards, which has got the highest rate of any of them. From my perspective, as someone lending people money on a daily basis, I would argue that your concern is a little bit misplaced. In other words, it's not the mortgage rates that really are the even primary affordability issue. In a lot of cases with a lot of families, the affordability issue has to do with a misallocation of your debt load against other type of loans at much higher rates that are causing you a problem for qualifying for that mortgage, even with that 6.8% rate. In other words, put my Dave Ramsey hat on, what I'm really trying to suggest is, in a lot of cases, what I see is some families need to reorganize their focus and reduce the kind of lending like these other types that we just went over with these much higher rates, whittle that down, get rid of that debt, reduce that debt, and reallocate your dollars toward the mortgage loan, the mortgage rate, because over time, what's the key difference between the mortgage loan rate and the underlying asset versus the others? Well, yes, an auto loan is a loan made on an asset, but we all know you buy a brand new car, it depreciates immediately, you drive it off the lot. Cars in general do not appreciate in value. And of course, an unsecured personal loan or credit cards, there's no underlying security at all to appreciate. It's only the mortgage loan secured by your house where you have an opportunity to gain some wealth in the future if that home value goes up. And in most markets, in most cases, in most environments, that does happen. So with all that, what I want to suggest to you is get used to where mortgage rates are. And if you're going to focus on other rates, reduce that other kind of borrowing that is at much higher rates where you're not getting any opportunity to gain an increase in wealth from an appreciating asset. And that's why I say at the bottom of the screen, and pardon my language, but I think it's the most effective way to get my point across. Only in America will someone go out to dinner tonight and put $200 on a 23% credit card and bitch about a 6.8% mortgage rate. I'm trying to be a little funny there, but at the same time, that's my underlying message is we've got to refocus our, where we're going to spend our dollars. And if we're going to borrow dollars, we got to decide what kind of borrowing, if we're going to do it, is going to be best for us in the long run. I would argue it's get a mortgage, get a house, have a chance at home ownership, and look at that home hopefully appreciating in value. So even though if you're paying that 6.8% rate, you're getting something in return. And then hopefully if rates fall, which we continue to hear those predictions, you can then refinance that note rate, continue with that home ownership, and get more increased wealth from the higher value, and then reduce your mortgage cost when that opportunity presents itself. So anyway, that's my take on interest rates. Mortgage rates, I think, get a little bit of a bad rap. Let's focus on those other rates, get rid of that debt. You're going to be better off and in a better position to get a mortgage loan, even at our current rates, which are going to be here for a while. Okay, with that, let's go ahead and move on with the end of my rant there. So now what I want to do is go over something that I just saw here just the other day, which was really kind of a shocker, although not really a total surprise. And it has to do with homeowner equity. As you might imagine, as I've been talking about for a while now, home values really have not fallen. In certain markets, yeah, there's some softness, but overall home values continue to creep up. We talked about last month, Kay Schiller pointed out year over year, last month that we had a over 5% increase in home values, and so that process is continuing. Well, this article, which was in Mortgage Professional from March 11th, Candide Minosa, that's not a misspelling of her first name, by the way. CoreLogic, that's a data analytics company related to the mortgage industry and financial markets in general. So CoreLogic indicates that their most recent numbers, homeowners with mortgages saw their equity increase by 8.6% year over year in Q4 of 2023. $1.3 trillion gain, averaging $24,000 per borrower. So total homeowner equity is now at a very high, almost $17 trillion. And what that means on average, and again, these are national numbers, the average home equity per borrower in the U.S. is almost $300,000. So that's good news. Again, that's why we don't have a 2008 situation like we now that we had then. Why? Homeowners, number one, were qualified for their mortgages that they have. Even though those 2 and 3% mortgages, we qualified them to make sure they had the ability to repay, and home values have been going up. So they got tremendous amount of equity. Right now, even with this increase in equity, it's estimated there's about 1 million homes in the U.S. that are still underwater in value. Well, after 2008, it was 12 million. So we're in a very, very good position. Homeowners as a group are in a very, very good financial position given this growth in equity. The average loan to value ratio for U.S. borrowers with a mortgage is at a record low of 43%. And so what that means is a typical homeowner has a notable opportunity to tap into those equity reserves and use them for hopefully a good purpose. And that's why I want to use that information to lead into you and remind you that Mortgage Works, we have a basket of equity loan options for homeowners to tap into this record equity. We can do primary home HELOCs and equity loans, HE loans. Those are fixed rate seconds. We can arrange those up to 95% of your value. We can arrange a HELOC on a second home up to 80% of value. We can arrange a HE loan, again, a fixed rate second mortgage on a second home up to 90% of value. We can now arrange rental property HELOCs up to 70% of value. We can arrange fixed rate second loans, a HE loan on a rental property up to 80% of value. We're now even using the non-QM approach for second mortgages, where we can arrange for you a HELOC or a fixed rate second. Generally, it's going to be for self-employed borrowers where their tax returns don't support qualifying for the traditional debt-to-income ratio requirement. We can use your business bank statements, develop a qualifying income, and use that to arrange a HELOC or a fixed rate HE loan on your property that's specific for self-employed borrowers. And then lastly, even you senior homeowners, you've got a good mortgage, you're handling that okay. It's got a very low rate, but you're still would like to get some access to capital. You got tons of equity. We now have a second mortgage product for senior homeowners. It's basically a reverse mortgage lookalike type of a second mortgage. There's no payments on the loan. It's called a Home Safe Second. So again, we have a variety of equity loan programs available to all of you homeowners with this record level of equity in your homes. So if you've been pondering whether or not to tap into that for variety of reasons, maybe paying off some of that credit card debt from our previous slide, although be careful about that. You don't want to repeat that debt after you use your home equity to pay it off. But that can still be a very good, approach to take on reducing that debt. But you may have improvements to the house you want to do, need to buy that solar system, put in a pool. We can help you with any of that. With all that equity, you can put it to good work and hopefully, again, build wealth or improve your property with these options. So again, congratulations on all you homeowners out there with that record equity. Just understand we can help you tap into that if you need to. With that, let's go ahead and go to our closing question from last week. And this one actually just came up about a month ago. I had somebody tell me, let me read you the question and then I'll give you some answers here. But what exactly is a DU approval and why is it that not all lenders will provide this when making an offer on a home? About a month ago, this came up. So this is a good question to cover. Because one of my friendly competitors here in my market area in the Palm Springs area, he and I had a conversation about providing a DU approval at the time a buyer is making an offer on a home, because in a lot of cases, listing agents and their sellers are asking for evidence of a DU approval before they'll consider an offer from a prospective buyer. And one of my again friendly competitors here in the Valley had told me that their company policy is they don't do that. They believe it's illegal to give a prospective home buyer, a copy of their DU findings. So I wanted to kind of get into the detail on that just a little bit. First of all, what is a DU? Fannie Mae and Freddie Mac, the two quasi-federal mortgage agencies, both use what's called an AUS system, or an automated underwriting system, for their preliminary underwriting decision. We even use that too when we're first pre-qualifying a buyer for a mortgage loan on a purchase or a refi for that matter. But again, Fannie Mae and Freddie Mac uses AUS systems, automated underwriting system, that's what the acronym is, for preliminary underwriting decisions. Basically a piece of software. So we put all the data of the borrower's financial profile into the system. The AUS system then analyzes that data and spits out basically an underwriting decision, and then a list of documentation that would be required to support that underwriting decision. Now, Fannie Mae's system is called DU for Desktop Underwriter. Freddie Mac has a similar system, but it's called, or often referred to as, LPA, for Loan Product Advisor. So either one of these systems, again, provides an initial underwriting decision recommendation and documentation required for the loan file. So that means that when an underwriter is reviewing an actual loan file for final underwriting approval, what they're going to be doing is they're going to review those DU LPA findings and the supporting documentation for data integrity. They want to avoid GIGO. What is GIGO? Garbage in, garbage out. What that means is the DU or LPA systems, these AUS systems, are only as good as the data put into them. So it's important that the data, in particular the numbers, the borrower's income, the borrower's monthly debt payments, and so forth, those need to be pretty darn accurate and need to be able to be supported by current underwriting criteria. In particular, this can be touching when you're talking about a self-employed borrower, where we're having to analyze tax returns and develop a monthly recurring stable income from the borrower's business after reviewing their tax return. So that does require some pretty extensive analysis and making sure you've got good numbers that are going to stand up to underwriting scrutiny. And again, is it legal to provide DU LPA results to a buyer submitting an offer on a property? I've checked into this. I found no evidence that's the case. It is true some companies may have a policy that they don't want to do that. I know some companies will do a DU, but they won't make it specific to a property. They'll use a to be determined property location or address, feeling that somehow keeps them from being, getting in trouble by providing a DU on an offer situation. We don't do that. If I have an inquiry to pre-qualify a buyer who's going to make an offer on a specific home, I'll get that property address. I am going to put it into our system. I am going to run a DU or an LPA using that address. And in our opinion, and after checking into this, we think it's legally okay to do that. Why? When we get those findings, I'm only giving those to the borrower. Okay. In other words, it's going to be the borrower's decision whether or not they want to share that with a listing agent and their seller. That's up to them. Our responsibility for what happens with those DU findings after we've obtained them stops with us providing a copy to the buyer or the borrower. And it's up to them if they want to provide that with their offer when they're submitting it to the listing agent and their seller. So that's our take on the DU approval and why it is that some lenders don't provide that when you're making an offer. We do. So if you need that help, feel free to contact us. We do it every day. And hopefully we can help you get an offer accepted with those DU or LPA findings and get you into home ownership sooner than later. So with that, good question. We'll move on to what's going to be our closing question for next week. This is a pretty good one in that I do get a fair amount of kind of commentary back from some of our newer borrowers that we're starting a transaction for when we come across conditions that are called for in underwriting. So here's the question. A friend who recently applied for a mortgage told me that during the process, the lender asked her to explain a few addresses from many years ago. What does that have to do with getting a mortgage to buy a home now? That's a pretty logical question, right? I mean, if the underwriter or the lending company somehow finds an address that they think you're associated with 10 years ago, why does that matter? Well, guess what? Stay tuned, think about that, and next week I'll give you the answer and it'll be on the house. Jeff, back to you.
Art, thank you again for another great show. I just have a couple of questions that'll follow up. With the California Dream for All program, there was a point in there about the foster care, and why again was that important for that particular segment of the potential market?
Well, the idea there is that this program has very high demand, and this added first generation test requirement is, I think, dampening the demand a little bit because we're, at least in our case, and I'm hearing this anecdotally from other lenders like here in my market area, what they're running into is people who are very excited and want to get involved, want to get pre-qualified and have a chance at the lottery, but they're falling down or falling out of eligibility because they have a parent who owns a home, or when their parents were alive, they owned a home. And so that's a hard stop. You're not eligible. But what we want to make clear is there's a segment of the population out there where the test as it relates to parents is really not applicable. There are people out there who grew up in the foster care system. So then maybe they were given away at adoption or somehow otherwise abandoned by their parents. They may not even know who their parents are or where they are and so forth. So if you can demonstrate as a first-time home buyer and you haven't owned a home for 7 years, that you don't have to provide any representation about parents because you were, growing up, you were in a foster care system, that makes you eligible for the program, and you don't have to, certify anything about parents owning a home or not. So,
Gotcha. Gotcha. A follow-up to that would be, what is the amount of money being allocated this time around versus when they did it a little earlier, I guess last year?
Last year, yeah. My understanding is 250 million.
That
Which,
sounds like a lot of money, but go ahead.
well, yeah, I mean, it does, right? But here's the way I think about it. And of course, we talk about all the time that a lot of our market areas in California are pretty high price levels, right? And with this 20% getting a down payment loan up to 20% of the purchase price of the home, or 150,000, whichever is less of the two, that effectively means the price level cap for this program is 750,000, right?
Mm.
750,000 purchase price can get you $150,000 dream for all down payment loan. Well, if you take 150,000 and divide that into 250 million, in a state with almost 40 million people, that goes pretty quick. So they're expecting, even with this new eligibility requirement, first generation requirement, that I think is going to diminish demand a little bit. There's still so much of it. I think it's still going to get used up pretty quickly.
A little follow-up also on your, interest rates. Let's get real. Just, I thought that was great because you pointed out that in three sectors that are going up, we don't seem to be so rate sensitive. I guess we're more monthly payment sensitive. But if we peel back that layer, as you suggested, and said, hey, what am I paying for the cost of that money? Could we then tap into some of that interest, let's say through a home equity loan that is under 10%, and pay these high pieces of interest rate loans off and see a decrease in our overall monthly costs?
Well, exactly right. I mean, that's really the whole focus on equity loans that's been going on for a while now. They can be a very good instrument if you're a homeowner right now. You've got a first mortgage. It's a very low rate. And yet some of these homeowners, unfortunately, their spending habits are such, they got a lot of this other debt. They got, it's a couple, a married, couple, and they each got a car loan. And between the two of them, the car loans are $1,800 a month. They got $800 or $900 a month each. And then, we don't have much credit card debt. You pull their credit, and they got, it's actually $32,000 worth. The minimum payments on that is not little. And what if they have an unsecured loan or two? So the point of it is, and again, this, when I said putting on the Dave Ramsey hat, if you want to put yourself in a position to qualify for a mortgage comfortably, you've got to really kind of look at your own behavior and kind of refocus where you're going to borrow money and what the cost is. In other words, too many times I'm pre-qualifying somebody and we're running into trouble, and they'll even say, the payment's too high. Why? Because they're not saying it, but they're thinking to themselves, $3,500 a month for this mortgage when I'm paying, $1,800 a month for two cars, and I've got, $700 a month and going to, $32,000 worth of credit card debt. If you two cars and get something for $300 or $400 a month and get rid of that credit card debt, voila, you suddenly $50,000 higher mortgage amount, or not a higher mortgage amount, but be able to more comfortably handle that lower mortgage payment if you don't have those other payments as well. And that's what we're seeing a lot of, because that auto loan lending, unsecured personal loan lending, credit card lending, it's really going up, which is odd. With the rates are so high, why are people borrowing more through a facility that's got record high rates, sometimes 2 to 3 times higher than a mortgage? It doesn't quite make a lot of sense.
Yeah, it doesn't pencil out, does it?
No.
Well, your information is on the screen there, Art, at 760-883-5700. Call there to get pre-qualified for the Dream for All. That's still available, right? You have that for a while?
Yeah, we have basically from now until April 29th to pre-qualify buyers and submit their pre-qual application and certificate so they have eligibility to participate in the lottery. So between now and April 29th, although I would urge, don't wait till the last minute. Get in early. Let's get you pre-qualified early. The window to submit those is April 3rd.
And they don't have to have identified a property before they do that, correct?
Correct. What happens is, what you're doing as that first step in the lottery is we're getting you pre-qualified, getting you submitted for the lottery, again, between April 3rd and April 29th. After April 29, the lottery closes. They then will go through all the submissions and allocate a Dream for All voucher. And the Dream for All voucher gives you 90 days to then find the property, negotiate a price, open escrow. At that point, you'll get your funds allocated.
Oh, that's fantastic. Well, his information is on the screen there. Art Alvarez with Mortgage Works at 760-883-5700. And of course, his cell phone is always available at 714-612-9035. And of course, you go to the website, mwloan.com. You saw that in the beginning. Not only do you see the current interest rates, but there's a lot of tools on that. If you saw the calculators and things like that down there, of maybe you want to say, hey, maybe take some of that equity and pay off some of my other loans. What is it going to save me? And you can use that there. Of course, you can always get a hold of Art at mwloan.com if you just want to drop him an email. Art, thank you so much. This is, as always, great information. And, I think it's okay sometimes to give us some Dave Ramsey slap there during that. I think sometimes we need to hear that, the reality check. So with that, I'll say again, if you have a question or a comment, you're watching this live or recorded, please put it in the comment section, whether it's on YouTube or Facebook, and Art will get back in touch with you. Art, thank you very much and have a great week, and we'll see you next week.
All right. Thank you, Jeff. Yes, sometimes Dave Ramsey, like tough love, financial love is a good idea. So anyway, appreciate all of you watching and listening to this week's Mortgage Minute. My name is Art Alvarez with Mortgage Works, where we have the answers on, and they're on the house. Stay tuned for next week. So long. Take care.